What looks like weakness in gold right now may actually be one of the most misunderstood signals in the entire financial system. This week, gold moved in a tense range between roughly $5,000 and $5,240 per ounce, and to the average observer, that looks like hesitation. It looks like exhaustion. It looks like the rally is fading. But step back for a second and ask a better question: is gold really failing, or is the system around it struggling to decide what breaks first? The Federal Reserve is still trapped by sticky inflation, with PCE near 2.8%. At the same time, U.S. GDP growth slowed sharply to just 4.7% in Q4. That is not stability. That is the quiet architecture of stagflation. Add in the war pressures surrounding Iran, Israel, and the Strait of Hormuz. A narrow passage where nearly 20% of global oil flows move through a single choke point, and you begin to see why the market feels so uneasy. Higher energy risk keeps inflation alive. Inflation keeps the Fed cautious, and cautious policy keeps pressure on gold in the short term through a stronger dollar and elevated yields. But that same pressure is also exposing something deeper. A global system held together by debt, delay, and fragile confidence. So no, gold is not simply pausing. It may be reflecting a world that has become structurally harder to trust. And that is where the next part of this story begins. But to understand why gold feels trapped right now, we have to look at the force quietly sitting in the background of every market decision: the Federal Reserve. Inflation has cooled only gradually, with core PCE still hovering around 2.8%, noticeably above the Fed's long-term 2% target. That leaves policymakers in a difficult position. Even as the economy shows signs of fatigue, U.S. GDP growth slowing to just 4.7% in the fourth quarter, the central bank cannot rush into aggressive rate cuts without risking a second wave of inflation. And this is where the pressure on gold begins to make sense. When interest rates stay elevated, Treasury yields remain attractive. The U.S. dollar strengthens. And capital naturally gravitates toward assets that generate income. Gold, by contrast, offers no yield at all. It simply sits there, preserving value rather than producing it. So in the short term, the metal faces what traders call policy friction. The market is not rejecting gold. It is recalibrating around the reality that monetary easing may arrive more slowly than many expected just a few months ago. And once you understand that tension between inflation, interest rates, and investor expectations, the sideways movement in gold stops looking random. It begins to look like a market waiting carefully, almost nervously, for the next signal from the global monetary system. Now widen the lens for a moment. Because the deeper risk forming beneath these numbers is something economists have a very specific name for: stagflation. When U.S. GDP slows to just 0.7, while inflation, measured through the Federal Reserve's preferred PCE index near 2.8%, refuses to fall quickly. The system begins entering a very uncomfortable zone. Growth weakens, yet prices remain stubborn. Policymakers lose flexibility, and markets start behaving in ways that feel confusing at first glance. We have seen this movie before. In the 1970s, a similar combination of energy shocks, geopolitical tension, and persistent inflation forced central banks into a prolonged struggle between supporting growth and controlling prices. Today, the ingredients are beginning to look familiar again. Energy markets are on edge as tensions involving Iran, Israel, and the United States ripple across the Middle East. Nearly 20% of global oil flows through the Strait of Hormuz, meaning even small disruptions can push energy costs higher across the entire industrial system. And when energy rises, inflation follows it like a shadow. That is the environment where traditional policy tools become blunt, almost ineffective, which means the market is no longer just reacting to data releases. It is quietly trying to understand whether the world is drifting back toward a macro environment it has not experienced for nearly half a century. And that realization changes how investors begin to see everything. And this is where the geopolitical layer begins to quietly reshape the entire economic equation. The conflict unfolding around Iran, Israel, and the United States is not just a political headline. It is an inflation mechanism embedded directly into the global energy system. Almost 20% of the world's oil supply moves through the Strait of Hormuz, a narrow corridor where even the hint of disruption can send shockwaves through energy markets. When oil prices rise, the effects do not stop at the pump. Energy flows into everything: transportation, manufacturing, fertilizer, plastics, and the cost of moving goods across continents. In other words, higher energy prices slowly leak into the entire inflation structure of the global economy. And that creates a dilemma for institutions like the Federal Reserve. If inflation risk remains elevated because of energy shocks, policymakers cannot move aggressively toward rate cuts. Even as economic growth softens and markets become more fragile, that tension is precisely why gold has not exploded higher despite geopolitical uncertainty. The same conflict that should theoretically support safe haven demand is simultaneously reinforcing the forces higher yields and a stronger dollar that restrain it in the short term. But once you recognize that contradiction, the market begins to look less random and more like a system balancing competing pressures. And that tension is only the beginning of the story. But here is the paradox most investors miss: the same forces that appear to be holding gold back today may ultimately become the forces that drive it higher tomorrow, when central banks like the Federal Reserve keep interest rates elevated to contain inflation, especially with PCE still around 2.8%. They are not simply tightening policy. They are increasing the pressure across the entire financial system. Governments around the world are already carrying record levels of debt, and every percentage point increase in borrowing costs quietly expands the burden of servicing that debt. In the United States alone, fiscal projections discussed across institutions like the Congressional Budget Office continue to point toward rising structural deficits in the years ahead. High rates, in other words, are not a permanent solution. They are a form of delayed stress. And over time, that stress begins to reveal where the system is most fragile, whether in sovereign balance sheets, corporate refinancing cycles, or global liquidity conditions. This is why many large institutional investors are not asking whether gold moves $100 next week. They are asking a much deeper question: how stable the global monetary system will remain over the next decade. Because if debt continues expanding faster than growth, the long-term conversation inevitably shifts toward currency credibility, and that is precisely where gold quietly re-enters the story. And this is where the perspective of large institutional investors begins to diverge from the noise dominating the headlines. Most retail traders naturally focus on what gold might do next week, whether it holds $5,000 per ounce or pushes back toward $5,200. But the major asset managers, the pension funds, and global portfolio allocators tend to ask a much quieter question. In a world where both equities and government bonds are facing structural pressures, what asset still behaves differently when everything else becomes unstable? This is precisely why institutions continue to frame gold not as a short-term trade, but as a strategic allocation. Firms such as ANZ and other macro research groups repeatedly describe gold as one of the few assets capable of providing true diversification. When traditional portfolios become fragile, stocks can fall when growth slows, bonds can lose value when inflation refuses to fade. But gold operates outside that conventional structure. It carries no counterparty risk, no balance sheet attached to it, and no central bank policy that can dilute its supply. That does not mean its price moves in a straight line. Far from it. Yet over longer cycles, gold tends to reappear whenever confidence in the broader financial architecture begins to weaken. And once you start viewing gold through that lens, the current consolidation looks less like uncertainty and more like preparation for the next shift in global capital flows. Now here is where the metal story becomes even more interesting, because while gold has been consolidating near $5,000 to $5,200, silver has been telling a very different story. In recent sessions, the metal pushed close to $60 per ounce, briefly touching $59.90, before settling around $58, $59, still higher on the week. That divergence matters. Historically, silver tends to move later in the precious metals cycle. But when it begins accelerating, it often moves faster than gold. One reason is structural. Silver is not only a monetary metal, it is also an industrial one. Demand flows from electronics, renewable energy systems, and expanding technology infrastructure continue to support its underlying fundamentals. Another signal lies in the gold-silver ratio. which recently slipped below the important 72 level, suggesting a gradual rebalancing between the two metals. If the ratio continues compressing toward the 65 to 62 range, it implies that silver may still be undervalued relative to gold. Markets rarely move in straight lines, of course, and volatility will remain part of the journey, but moments like this, when one metal pauses while the other quietly gathers momentum, often mark the early stages of a broader shift in capital flows across the entire precious metals complex, and once that shift becomes visible to the wider market, the narrative surrounding both metals can begin to change, much faster than most investors expect. And when you step back and connect all of these signals together, the story begins to look much larger than a simple weekly fluctuation in gold prices. What we are really watching is a financial system balancing multiple pressures at the same time. On the surface, gold remains trapped between $5,000 and $5,200, reacting to short-term forces like a stronger US dollar, rising treasury yields, and uncertainty around the Federal Reserve's upcoming FOMC decision on interest rates. But beneath that surface, deeper structural forces are quietly building. Economic growth in the United States has slowed to 0.7% in the fourth quarter, while inflation measured through PCE remains near 2.8%, creating the uncomfortable conditions economists associate with stagflation. At the same time, geopolitical tension surrounding Iran, Israel, and the Strait of Hormuz continues to threaten the stability of global energy markets, through which roughly 20% of global oil supply flows. These pressures are not isolated events. They are interconnected pieces of a system adjusting to a more fragile world. That is why the current consolidation in gold may say less about weakness and more about timing. Markets are waiting, recalibrating expectations, and searching for the next signal. And once that signal arrives, whether from policy, energy markets, or global growth, the next phase of the metals story could begin unfolding, far faster than most people expect.